100%. 100%. And and if nothing else, it goes to show how fragile our markets are, where a couple of servers overheating can take down our markets for 12 hours.
Mm-hmm.
The global price setting center for the world on metals, it overheated a server, and that takes it down. It just goes to show that, they'll protect their own the best that they can. But so far, in the first 3 days of the December contract, we've seen almost 45 million ounces of silver delivered. Multiply that times $60 or thereabouts, and what are you at? Like 2.5 billion. Well, before I answer the question from a technical standpoint, I'll tell you, look, I try and see what the big money is doing.
Mm-hmm.
And the big money in this country would be whoever the hell is standing for possession of over 13,000 tons of silver so far this year. These are people that don't do this just for the hell of it. These are people who have billions and billions of dollars who are standing for delivery at COMEX. That's more than the output, that 13 billion tons, the combined output of Mexico, China, and Peru, the three largest producers of silver in the world. That's more than the combined output of those three. And I think the biggest money on the planet here in the United States, forget about Russia, forget about China, forget about India, forget about Saudi Arabia, who have all been buying the hell out of it. And I've talked about that forever. Whoever's doing it here in the United States, and I think it's just really strange, or I think it's an indictment against the entire journalistic integrity of all of the journalists in this country combined, that no one talks about it. We've seen so much metal coming into the country by the most sophisticated and well-informed traders in the world who do not do this just for the hell of it. Where is the reporting? Now, before I answer your question again, let's talk about how much has come in so far, just in the first 3 days of the December contract that went off the board on Friday. Now, before I say that, it's interesting, isn't it, that Friday was when the December contract went off the board, and those that stand for delivery do so. It's also interesting on Thursday night, Thanksgiving, and when there's not a lot of volume going on Thursday night, the New York traders are still, sleeping off their turkey high, whatever that thing in turkey that makes you fall asleep. Nobody was trading anything, and yet the server farm in Illinois overheated just for the CME groups, which is the COMEX, just for their metals set of servers. Forget about the 2 and 3 times redundancy that these server farms have with air conditioning units. So it overheated, was what we were told. But
Mm-hmm.
these server farms are built with double and triple and quadruple redundancy for cooling.
Right.
That one overheated.
And this was right as silver futures were really making a run up to like 57, right?
Correct. And in Asia, and bang, they shut it down. Now, there's all sorts of rumors about huge delivery requests, demands, huge, but they shut down for about 12 hours. And this is as you got massive short positions. You got the squeeze happening in London, where there's 2 billion ounces of contracts that's, backed by only 145 million ounce free float. What could possibly go wrong there? All of that stuff is happening, and yet we're supposed to believe that the CME group, none of their other servers overheated, like forex or interest rates or equities. Just the metals servers overheated for 12 hours. So keep that in mind.
Just as December futures expired, the precise moment when traders declare physical delivery, an unusual incident unfolded. On Thanksgiving evening, when markets were thin and volume nearly absent, the CME Group reported that only its metals trading servers overheated, despite extensive redundancy systems. The outage lasted almost 12 hours. This happened while silver prices were surging in Asian markets, and rumors of massive physical requests were circulating. Other asset classes remained unaffected. Whether coincidence or not, it highlighted how dependent global price discovery is on a small cluster of vulnerable systems.
So there was a congressman like 6 months ago or so that didn't want a vote to happen in the House. And so we pulled the fire alarm.
Yeah, that's exactly what it is.
To you, does this smell just like that? Yeah.
100%. 100%. And we're and if nothing else, it goes to show how fragile our markets are, where a couple of servers overheating can take down our markets for 12 hours.
Mm-hmm.
The global price setting center for the world on metals, it overheated a server and that takes it down. It just goes to show that, they'll protect their own the best that they can. But so far, in the first 3 days of the December contract, we've seen almost 45 million ounces of silver delivered. Multiply that times $60 or thereabouts, and what are you at? Like $2.5 billion or something, just in the first 3 days, and it will get bigger than that alone. We've also seen almost 2.5 million ounces of gold delivered just in the first 3 days. But this is everything. Every single month we are seeing this. Every single month. And so you're talking about the most well-informed and well-funded traders on the planet. Now, how high can it go, right? Okay, technical analysis would say the following. When you have a cup and handle like this, a 45-year cup and handle, the longer the duration, the higher the potential, the more condensed all of that energy is. And so anyways, you take the top of the cup, which would have been 1980 at $50, the bottom of the cup in the early 90s, about $4, and then you add it to the top of the cup or the top of the handle when it breaks through. The difference, 50 to 4 is 46. So you would add it to the 50. 96 was what technical analysis would say would be your next target. But there is no resistance up there. It's never been that high. But if you employ that logic, yeah, triple digit silver is not something that's crazy. And let's look at it another way from a conservative standpoint. Right now we have gold at 42.20, call it. Okay. You take 42.20 and you divide it by the 100-year average of gold and silver, man's ratio, right? About 42 to 1. Well, that's $100 right there, isn't it? 42.20 divided by 42. It's going to be $100. It's coming out of the ground at 7 to 1.
Yeah.
So if you took 42.20 divided by 7, if you woke up tomorrow and silver was $600, yeah, that sounds crazy, but that is the geologic ratio right now. Every ounce of gold that comes out of the ground, the equivalent in silver right now is 7 to 1. It used to be 16 to 1. But because it's found like your skin is epidermis in the form called epithermal right near the surface, it's depleting. The big deposits were found forever ago. And so, you're talking a billion plus ounce shortfall between supply and demand in the last 5 years. This will be the 6th year. I think it's the 6th, where we're seeing the same exact thing. Demand is outpacing supply. Supply is diminishing. The geologic ratio is diminishing. The massive deliveries on COMEX and LBMA. And think of it this way. It's a whole hell of a lot easier for you to send me a wire for $50 million and take possession of that or have it delivered into a vault than it is to start taking this kind of volume off of COMEX. Whoever is doing it is the most sophisticated and well-funded traders in the world. And at that level, you're well-informed too. So I would say to you that it's as much the technical side as it is who is investing billions upon billions every month for the last 12 months since he won the election. Who is it and where's it going? This is the kind of volume that is so unusual that the fact that no one's asking about it but guys like me is just insane.
In London, the situation is even tighter. The LBMA maintains roughly 145 million ounces of freely available silver, yet more than 2 billion ounces in paper contracts trade against it. That's hundreds of claims for each ounce that actually exists. Silver inventories have drained steadily in London, New York, and Shanghai, a trend intensified by industrial demand, investor interest, and national strategies. China, for example, has recently tightened rules on silver exports, requiring state approval for outbound shipments. Combined with relentless physical demand on Western exchanges, the gap between real supply and synthetic claims continues to widen.
Funny you say that. I saw that last night too. Fact checked it. Couldn't find any credible evidence saying it. But maybe it is true. I mean, and to your point, Again, see, I do try to fact check everything, and I saw that, and everywhere I looked, I couldn't find validation of it. But wouldn't surprise me. But to your point, when I say who the hell's taking possession of all this, maybe it is Apple securing, and Samsung, and Sony, and maybe they're going directly to the miners like Tether is doing, disintermediating the marketplace. But I would think that any of these large uh, industrial manufacturers that need silver for whatever it is, if they haven't secured it by now, they're out of their flipping mind. And
Right.
here's where it gets crazy: is there will be a battle, and I think we're right on the heels of that battle between said industrials and the hedge funds, who say, I smell blood in the water. And
Right.
silver is what's called a Giffen good. And a Giffen good means as the price goes higher, the demand goes higher, because in other words, these people, like you just mentioned, say, man, if we don't secure this, we're dead in the water. So go, 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 get it, get it, get it. Because if you don't, you can't make your product. So everyone secures it, the price goes higher, and that we better get it too. And so as the price goes higher, a Giffen good means that the demand accentuates tremendously. And it's usually not that way. It's the opposite. When price goes way up and other stuff, demand falls off, not with silver. And in this case, silver being an industrial metal that was just classified a critical mineral by the US government. It was done so by the European Union in 23. And China's response is, well, we're going to massively limit exports. Now, they're the second largest producer in the world and a big exporter. Anything that is exported out of China now must be permitted through Beijing. What's it for? They're going to massively curtail exports. It's a race for the real thing, which would make these industrials say, we're running out of time and we need to make this stuff and we need silver, get it. And I think you could see that start to snowball very, very quickly.
From a technical perspective, silver's long-term structure resembles a massive multi-decade cup and handle formation. Traders often interpret such patterns as reservoirs of compressed momentum. Using conventional measurements, the implied price target could extend toward the mid-$90 range, with no historical resistance beyond that point. Ratios also tell a story. Gold trades around 42 times higher than silver, while geological extraction now occurs at roughly 7 to 1. If silver ever realigns closer to its natural output ratio, price projections climb sharply. In short, fundamentals and technicals are pointing in the same direction, upward.
Yeah, I don't know the exact number, but I would argue it's pretty darn close to the lowest number they've had maybe ever, or in a very, very long time. And, you know, people are taking possession of silver out of Shanghai as well. Their public is. And so they're incentivizing it. Yeah. And, you know, the piggy banks are running dry everywhere. And it's not just London, it's not just COMEX, it's the Shanghai market as well. Um, and that's something I would expect to see continue across the board. The LBMA has its lowest level, maybe in the history of the recorded records or record keeping of the LBMA, 140-year-old exchange, and the same thing is happening now in the Shanghai exchange as well. Yeah, that their levels have been bleeding down every single month.
Okay, so this tightness is not just in one or two nodes. It seems to be in all the nodes.
And not only that, at the same time, China says we're going to limit exports, and the U.S. says it's now a critical mineral, and so it's progressing. It's progressing, and with that, the price is going higher, and with that, you shut down the COMEX because of a server overheating. Because now the rumor was, and I don't even know how the hell this rumor gets any validation. I don't know. The rumor on X is that 400 million ounces were requesting delivery. Now, there's not even. That's way more than there's on in the registered category. Not sure where that rumor is coming from. One big Asian trader said, I want 400 million ounces. All I can tell you is this, that these rumors, a lot of them lack substantiation, and a lot of them may be just, just that, a rumor. But I think where there's smoke, there's fire. And the way that I would break it down is that at that level, you're seeing shortages and strain in the system, and rehypothecation in London will be the death of them. And, it's true. Big money is I think for the first time understanding that physical possession is the way to go, getting it off of the exchanges, taking possession, buying it, and standing for delivery. This is what's different about this market. Nobody stood for delivery my whole career, and now
Right.
you're seeing it every single month. And I guess the exclamation point to me is that the amount of metal coming into COMEX every single month, it's different when I say the central banks around the world. People kind of lacks it lacks the oomph because it's not happening here. When I tell you it's 4 feet of snow in Death Valley in July, what's happening on COMEX right now, we've never seen these kind of deliveries, and the lack of any questioning it, by any of the mainstream, it's crazy to me, unless it's all by design, because it's very, very, very unusual, and it should be front and center news. Because
Mhm.
what does it really mean when you're seeing this kind of volume of gold and silver, the antithesis to the dollar? What does it really mean when the biggest money in the United States is doing that and no one's asking who it is?
Right.
So
So
to me, it means a
so
lot.
Silver is no longer just a monetary metal, it's an essential industrial input. The U.S. government officially classified silver as a critical mineral due to its importance in solar technology, electronics, medicine, and energy systems. Europe did the same in 2023. With supply stagnating and deposits becoming harder to locate, industrial giants may soon compete with financial institutions for remaining inventories. In markets where scarcity grows, demand doesn't slow, it accelerates. Silver behaves as a giffen good, where rising prices increase urgency, not reduce it. A scramble between hedge funds and manufacturers appears increasingly likely.
In London, it's believed to be between 400 and 500 to 1. Um, Number of contracts issued versus bars available. And you can look at right now, there's 45 million ounce free float. Say there's 700 million ounces in the LBMA, in the London market, of which over 500 of it, 550, belong to the ETFs, largely SLV. So that leaves about 140, 150 million ounces that is supposedly called the float, which is debatable as well based upon what's happened recently. But if we take it at face value, there's 2 billion ounces in contracts out there that could stand for delivery against 140 to 150 million ounces there. Doesn't add up at all. And so the rumor has been between 300 and 400 paper contracts for every 1 ounce, but who really knows? A lot, a lot.
so an awful lot. So this is like It's a Wonderful Life on steroids, right? Where everybody comes to the bank and demands their deposits back, and of
Yes.
course it's a fractional lending environment, and so the bank just only has a fraction of the deposits on hand, and then basically you have the run on the bank and it breaks the bank, right?
Yeah, and in Shanghai, it's the opposite. So if you want to buy a bar and do something in Shanghai, first of all, it's largely cash and carry. Here's your money, here's your bar.
Mhm.
But first, in order to trade on the Shanghai Exchange, you have to buy a bar from one of the handful of pre-approved deposit or refineries. Then they laser inscribe the certificate number that you will possess on the bar,
On the bar.
1 to 1. And so that's the thing. So much of what I see, Adam, in this world right now centers around lack of trust. Whether you're talking our institutions, the judicial system, the Federal Reserve, our politicians, our banks, our treasury market, our dollar, fiscal irresponsibility, everything. No one trusts anyone. What's going on in the repo market right now? The banks don't trust each other, or they don't trust the collateral. It's trust, and I think what these markets are doing here in the West is losing trust based upon those kind of perceptions of rehypothecation, of servers going out, of all of these things. It lacks trust, and there will come a point, I think, where trust is broken and not repairable. You have institutions like the Shanghai Metals Exchange who's waiting for the opportunity to be the price setting mechanism of the
Mhm.
world. And they have done it in a way that inspires legitimacy. Granted, yeah, it's in China. Who trusts China? Well, who trusts us? And if you have a market where the bar is laser inscribed with your certificate, well, that's a good start.
Right.
And I think that's kind of where we're going, and away from the futures exchange into a cash and carry exchange. And that's the way most of them are set up in Dubai and in St. Petersburg and in Moscow and in Singapore. They're cash and carry markets, less futures markets.
Across exchanges worldwide, investors are withdrawing physical metal at unprecedented rates, from the COMEX vaults to Shanghai's tightly controlled bar tag delivery system. Unlike Western futures markets built on leverage and promises, Asian exchanges often operate on a cash and carry model. Pay for the bar, receive the bar. This structure enhances transparency and builds trust, something the West is struggling to maintain. As questions grow over rehypothecation, server outages, and inventory depletion, confidence is migrating toward markets offering verifiable ownership. A transition toward physically settled trading may reshape which regions determine global prices in the years ahead.